Asset consultants will have a role to play in the future. What that role is, I think will be potentially dramatically different.
Asset consultants are changing, they have to change, but they haven't changed as quickly, I don't think, as the fund managers in the market as a whole.
I can see possibly some funds, rather than having just one asset consultant, they might start to use more than one.
Most funds tend not to have general consultants, but more specialised asset class based consultants, and I think that trend will continue as more investment decision making comes in-house.
There's no doubt that it's been really challenging for asset consultants over the past few years, but if anything, the need for asset consulting and for good advice by investment boards is greater than ever. But the future of asset consulting is those that can provide specialist advice, those that can actually fill the information gaps that the funds have, because the funds are becoming more specialised now, and those that can really bring a truly global perspective to the advice that they're bringing to the different investment decision makers. So,
over the next 20 years, as the size of the total pool of monies, and I suspect the number of funds in existence means that individual funds will be multiple tens and probably hundreds of billions of dollars, you'll certainly see that kind of skill set sitting within the fund themselves, and you'll see the role of asset consultants, I think, in the end, diminish.
It's really quite hard to, I guess, assess an asset consultant, particularly when the asset consultant may make a number of recommendations which you may decide or not decide to implement. So do you hold the asset consultant accountable for the things that you implemented or that you didn't implement?
I have to say that my favourite quote is from Ken Marshman, when he said that there are many ways to skin the investment cat. And it's good to have asset consultants, I think, continually challenging trustees and coming up with ideas and propositions that do skin the investment cat.
Well, our agenda this afternoon is as follows. Each of our team members, each asset consultant is taken a 5-year period and will provide us with a walk down memory lane, the highs and the lows, but looking back historically over that period. And of course, our first speaker is old Father Time himself, Ray King. Ray's going to talk about the 1990s, and take us forward 5 years. So Ray, without let me just sort of give a brief background. I know many of the people in the audience know who Ray King is, but I think it's important that we just have a look at a bit of Ray's history. Ray King or Sovereign Research is the company that was founded by Ray, a company specialising in providing investment research and consulting to institutional investors in the areas of alternative investing and asset classes. Sovereign established a strategic relationship with a group called Cliffwater, a leading global advisor in alternative investments, in 2009. Ray has worked extensively with leading superannuation funds in Australia since 1987 and is one of the more prominent asset consultants in Australia. He joined Towers Perrin in 1990 and was manager asset consulting until 1994, when he resigned to join Gary Weaven to help set up Industry Fund Services. As head of wholesale business, he was responsible for the development of its asset consulting and funds management and advisory businesses. He left in July 2000 to establish Sovereign Investment Research. Without any further ado, over to you, Ray.
Thank you. Thanks, Michael. I'm not sure what purpose can be achieved by talking too much about the first half of the 1990s. Very interesting times. It was probably the nursery years of asset consulting. Asset consulting, for those who probably aren't aware, really sort of only happened in Australia in late 1987, early 88, and there was, I think probably by 1990, there was probably about 4 or 5 key players. It was, the debate was fairly interesting. The asset consultants were actually set up by the actuarial firms and the administrators to ensure they basically kept their competitive position. They really didn't want any of their competitor organisations using asset consulting as a way of getting leverage into their client relationships. So they tended to be quite happy to do that on a relatively low budget and minimal service type arrangement. Now that was very difficult to the people who came into the profession at that time. We're talking about people of the calibre of, at Towers Perrin we had Ron Bird, David Lee, Greg Vaughan, I'll forget some of the others. We had, at Russell there was John Bowers, Chris Condon I think was there at that time. At Mercer was Brenda Shanahan, Richard Codron, a number of people, and of course Jana with John Nolan, Ken Marshman, Coombsy and a few others. So, you know, these were people who really had a sort of, you know, had quite a passion about what they were trying to do. And it led to quite a bit of debate. They were christened with the role of the gatekeepers, and in many cases some of those people liked to play the role of the gatekeepers. The big issues were they interfered with the cosy relationship between the manager and the trustee. They tried very hard to upset the relationship about having balanced managers, and were very strong in raising the debate about passive and active. As well as that, the other thing was trying to get the funds to realise that the wonderful days of capital guaranteed policies were coming nearing to an end, thinking about the next transition after that. So it was a pretty exciting period. Investment innovation was exceptionally high for a relatively junior profession. The interesting thing is that most of the clients really had probably at most had one full-time staff member. So it was very much a consultant to trustee relationship. I think as I said, the innovation, the active passive really opened up some new debates, pushing from balanced to specialist managers. We talked about mandates, benchmarks, pooled fund, individual accounts, what type of style, what type of tracking error, and it was a fairly high degree of innovation. The rivalry between asset consultants was quite fierce. It was very rare for two asset consultants to sit on the same platform and be friendly and discuss what was actually happening in the industry.
Okay. Well, that was from Old Father Time. Now, this gentleman's not quite as old, Mr. Coombe. John, would you like to take us from 95 to 2000?
Certainly. My period is probably the most boring because, in a sense, the government had set up the superannuation schemes, and now we had another government coming in and wanting to regulate it, and wanting to make certain that there wasn't going to be any mistakes. So we had CIS, we had licensing, which I think basically changed particularly for corporate super, changed the whole regime for their licensing of trustees, choice of fund, and everybody moved into member investment choice. From an investment point of view, it was a fantastic period. It was probably the best 5-year period of the whole 2 decades, Michael. So a lot of clients were quite comfortable and happy. And I suppose the biggest debate at the end of the 5 years I'm talking about was how much you had in global equities as opposed to Australian equities. And some of us got that right and others got that wrong. Some of those who got that wrong aren't even around anymore. In terms of the asset consulting market, it was really a period of a lot of players came into the market and also left. So you had this period of rapid turnover in people at different funds. And I think the biggest issue for an asset consultant in those periods was really convincing clients that, particularly industry funds, to actually enter into the choice and really how they were going to set up their investment choice. And I distinctly remember 2 conversations I had. One was with Ian Silk and one was with Michael Lillicrap. Ian Silk told me I was a B idiot, which was his way, because I suggested that they have 10 investment options, I think it was. Wrote a fantastic paper. Ian thought it was a load of bollocks and said we should have 3. Jeremy agrees with you now, Ian. And Michael Lillicrap said, Coombsy, I don't want to be the first one there, but I think we'd better have more than less. And I think they had 10 or something at the start. So I think that's my recollection of the 5 years up to 2000.
Well, John, I either paid you a high compliment then or a great degree of disrespect, because I introduced Ray and his background and I just assumed everybody knew who you were. But for those that
move
didn't,
on to Fiona. Leave me
those,
alone.
For those rare people in the room that don't know John, he's head of consulting for Jana in Sydney. Prior to joining Jana, his experience included 10 years at the State Electricity Commission of Victoria, where he worked in the superannuation, treasury and accounting areas. At the SECV Superannuation Fund, John was involved in internal management of Australian equities and bonds. So, now let's move on to Fiona, again a name very well known to all of you. Fiona is the Managing Director and Senior Consultant with Frontier Investment Consulting. She originally joined Industry Fund Services as a Manager of Investment Services in August 1994 and was a foundation staff member of that company. She was promoted to Manager Investment Advisory Services in October 97 and took responsibility for the management of IFS's asset consulting business from that time. She transferred to Frontier at its inception in July 2000. Fiona, over to you.
Okay, thank you. Thanks, Michael. The 5 years I'm covering are from 2000 to 2005, and that was a fairly tumultuous time in markets if you think back. Unfortunately, it's been well and truly usurped by the period in the last 5 years, which Graham's going to cover with the global financial crisis. But the new decade dawned pretty brightly. Equity markets were at all-time highs. The dot-com boom, now called the dot-com bubble, was well and truly with us, but at its end. And in fact, in March 2000, we saw beginnings of massive corrections in equity markets. And in fact, the NASDAQ has not regained its highs. Many other equity markets have regained their highs, but the NASDAQ reached 5,100 in March 2000, had increased by about 50% in the prior 12 months, so clearly bubble-like returns. By March 2001, it was down at 1,840, and even prior to the global financial crisis, had only reached 2,800. Now it's around 2,350. And I found a statistic which said that around $5 trillion was wiped off the value of IT companies in the period from March 2000 to October 2002. Looking back now, though, having been through the last few years, that doesn't seem like it was that bad. But it was, in fact, the first period of time in which trustees had to deal with negative returns on a financial year basis. Our funds here in Australia weren't as badly affected as global funds because our market had held up relatively well, but still we did have negative returns to deal with. As John mentioned, member investment choice was already common, but many funds were offering more options and many more funds were offering options, so that whole platform had continued to expand in those 5 years. It was the beginning of a movement in corporate governance. In particular, the period from around 2000 to 2002 was one of initially anger and ultimately action on corporate governance issues. And I remember a time when all we could talk about were Enron, WorldCom, HealthScope, Tyco, and reading stories about Dennis Kozlowski, who was the CEO of Tyco, with his $6,000 shower curtain and his $15,000 umbrella stand in the shape of a French poodle and all those sort of things. And it seemed hard to believe then, and it's hard to believe today, but unfortunately we've seen some of that kind of behaviour in the last few years as well. And I'll paraphrase Jeremy Grantham from GMO when he said something like, following a crisis, in the short term we learn a lot, in the medium term we learn a little, but in the long term we don't learn too much. And there was certainly some seeds of change that started in that early period that have come through on the governance side now, which is very positive. The other momentous event in that period was the first super fund performance survey. 2003 was launched, a very brave new world. It was backfilled 5 years. And that, in my mind, created a strong culture of looking sideways and being worried about competitor risk. And it's easy to argue that we ought to be accountable and transparent, but it's hard to argue, in my opinion, that monthly surveys of super fund returns have been good for members. In 2002-2003, the SGC kicked up to 9%, and it stays there today. And obviously that's debated a lot, but it did reach its final point so far in 2003. And 2005, we saw the introduction of fund choice, and this was a major change for the industry. And there was a lot of talk at the time about whether members would move. Didn't really pan out that way in terms of moving from fund to fund, but we have seen a substantial rise in the number of self-managed super funds. And just to give you an example, and I'm encroaching a little into Graham's territory here, but in June 2005, there were 300,000 self-managed super funds. June 2009, there are 414,000. To give you some parallels, corporate funds fell from 962 to 190 over that time, industry funds from 90 to 67, public sector funds from 43 to 40. And I think as an industry we need to look at why so many people are leaving large funds with scale, and for the most part pretty reasonable returns to do something on their own, when clearly for most of them it's harder and more expensive. Not all, but most of them. Asset allocations changed over the period. We became more growth oriented, if you look at the Mercer survey, and more in global equities, which feeds on to from John's theme as well. Some new firms have emerged in this time. Frontier emerged out of IFS. Watson Wyatt really came out strongly in asset consulting in around 2000. But on the whole, it's not been an industry with a lot of new players. I think one of the key things about this time for me, from an asset consulting period, is a lot of people worried about what other people were doing. The funds became quite worried about what their competitors were doing, a lot of looking sideways, and an increasing awareness by global firms of the mandated growth here. And so we have seen a lot of interest in global equities and global bond managers coming to this market. But the biggest impact, I think, on firms like ours that are probably continuing a trend, and they continue today, is the need for greater specialisation and access to more experienced people. So that has had quite a substantial impact on resourcing with, I think, most of our firms. Thanks, Michael.
Thank you, Fiona. And last but not least, we've got Graham Miller, Head of Investment Consulting Australia, Towers Watson. Graham is responsible for the management of Towers Watson's, formerly Watson Wyatt, Australian investment practice, which advises Australian institutional investors with funds under management of around 200 billion Australian dollars. Graham has 20 years' experience in the financial services industry and has consulted to some of Australia's leading superannuation funds, government bodies and private sector organisations. Well, Graham, your period is quite easy because it's just so full of excitement and dynamism. You've got a cakewalk.
Yes, indeed. The most exciting period, I think, in this 5-year period, we had two booms. We had a bust. We had the global financial crisis. We had massive rises and then massive falls in interest rates. But I think you'd only call this period exciting if you were really paying attention. Because this is pretty interesting. If you had $100 in your super account on the 1st of January 2005, and you simply went to sleep and did nothing, 5 years later, if you'd woken up on the 31st of December 2009, you'd have about $126.60 if you were in the average balanced fund. To keep pace with inflation, you would have needed to have about $116. So you'd be ahead of inflation. Had you invested in a growth fund, you'd have $125.70. A high growth fund, $125.16. Conservative fund is $127. A capital stable fund is $126. A cash fund is $125. A fixed interest fund is $125. These are all numbers from the Super Rating Survey. It doesn't feel like a very exciting time to me at all, does it? In fact, if you were going to make one decision before you went to sleep, there was only really one decision that you needed to make in order to determine whether or not you were going to be successful from an investment perspective during this period or not. And that was the split between Australian equities and international equities. And your $100, had it been invested exclusively in Australian equities, would have grown to about $151, whereas if it was invested in international equities, it would have shrunk to 94. So really only one decision during that period that you needed to make at the start, and then you could have just put your head on the pillow and gone to sleep. But of course, while you were sleeping, there was this massive volcano erupting all around you, this massive volcano that we all know, that we've all analysed and that we've all debated and discussed, the global financial crisis. Not going to talk in detail about the cause and the effect of the global financial crisis. We've spoken a lot about that. But really, we see this as occurring as a consequence of what we call the 4 C's. The first C is excessive complexity in the global financial system. Certainly excessive competition for a limited number of investment returns and limited number of investment opportunities, increasing connectivity between investment markets and investments that many participants just did not see coming, and of course excessive compensation as well, and excessive compensation particularly in the financial services industry, leading to misaligned interests and giving rise to some of the excesses that we saw in the global financial crisis. So if we try to summarise the period, I would summarise the period certainly as one where many of us, many of you, tried to squeeze the return lemon just a bit too hard. If something doesn't work without massive amounts of leverage, be very, very careful. The period was also characterized by a relentless pursuit and the continued relentless pursuit of diversity, and if you like, a little bit of endowment envy as well. Perhaps to the point where the destination was somewhat obscured by the journey, and perhaps not enough attention paid to liquidity, and certainly not enough recognition of the massive first mover advantage, first mover benefit that's associated with many of these opportunities. You're not going to get the same returns being second or third or fourth cab off the rank. Probably the most profound effect during this period from an investment consulting perspective has been the rise of the internal team and the chief investment officer. It's not all that long ago, Michael, that the people that we were consulting to generally knew a little bit about investing. And that's changed a lot now. The people that we are delivering our consulting services to are generally experienced investment professionals with large, well-resourced teams, and that's changed the dynamics of the relationships, and that's meant that we as consultants have had to evolve quite a bit. Certainly dynamic asset allocation has been a little bit of flavour of the month as a consequence of the boom. People have said to themselves, we're not going to be caught napping again. And speaking of sleeping, the final defining characteristic, I think, of this period has been the boom in the self-managed fund sector. Almost from nowhere, and I guess while all of you in this room have been sleeping, if you like, the self-managed fund, the self-managed funds part of the industry has grown to become the largest single sector in the industry. And I don't know about you, but I kind of look around and say, when did that happen? What were we doing while that actually occurred? And in many senses, all of us in this room, all of you in this room, represent perhaps a fringe part of the industry, and self-managed funds are now mainstream, and of course they comprise the largest account balances. And one of the challenges, I think, for all of us is how we respond to the self-managed fund phenomenon. So.
Thanks, Graham. Well, ladies and gentlemen, that's the opportunity for asset consultants to have their 5 minutes of fame and to talk about each of those periods that they saw and they lived through, and to chart the course of where we've come to, and it finished up with Graham saying this. It's interesting, Graham asked the question, and we may come back to it, of course, did trustees see it coming? Well, I suppose our question is, did asset consultants see it coming too? And I refer to the global financial crisis. We had the good fortune of having Jeremy Cooper with us yesterday, and the subject, of course, of fees came up. And Fiona, you've been very brave in the press in recent times. You've spoken out very strongly and said that flat fees are a good idea. Now, I've got to say, I've got a lot of fund manager friends, and I have yet to find one of them that thinks that's a good idea. Can you tell me, is the idea dead? Are you flogging a dead horse? Is it actually sort of viable? Would any respectable fund manager agree to pay a flat fee?
I don't see why it shouldn't be viable. I think you can argue asset-based fees if your work increases as the size of the mandate or the fund grows. And in a lot of cases with asset management, that just doesn't occur. And asset-based fees are an artefact of an old system where managers raised a whole lot less and they used a percentage basis to calculate what it would be in dollars, and that was the dollars they needed. But we have this system that we've hung on to, and no one questions it because it's just how it is. And so I decided that mindless attachment didn't make any sense. And it's something that happened during the global financial crisis. A fund manager rang me and said, a privately owned firm rang me and said, you know, things are really bad, we're going to have to lay off 10% of our staff. And I said to the guy, oh, but you're a private firm, why don't you have cash reserves, or can't your partners put money back in? Oh, no, but you don't have to worry, none of those people were important to the investment process before. And I said, then why were we paying for them? And he said, oh, I didn't mean that. I'm like, well, what did you mean? So those conversations were had many times with fund managers during the global financial crisis, and it just seemed to me that if you couldn't rely on them to look after the clients when things are really bad, then you would need to change the way they were aligned with the clients and with the members. So it just seemed that it was something that an individual member didn't have a voice, but I could have a voice, and I could use that voice, and I could keep banging on about it to see if we could get some change. I don't think the whole industry is going to go that way, but we are seeing some mandates going that way. And I think those will be the ones, if they're good managers, they'll be the ones that are going to be appointed by the clients, because I think that's a much more equitable way to charge.
So have you thought of this idea yourself, or are trustees pushing for it? Or are trustees encouraging you to do it, or have they not said anything?
Most of the people we talk to at the trustee level are encouraging. They want it to happen, but they can't quite work out how they can make it happen. I think every trustee thinks I'm just one person, but every trustee sits around the table with other trustees, and that creates a fund, and then there are groups of funds that can say, well, hang on a minute, we're going to do this differently. So the reality is the trustees in the room and the investment people in the room who are representing members and looking after their capital, you're the ones who can make these decisions and can make it happen. The trick is you need to be prepared to walk away, because managers don't want to change the way they get remunerated. It's very nice to get asset-based fees, especially when the market goes up all the time and we have mandated SG and this sort of thing. So asset-based fees are a pretty quick path to riches for many firms. But it means there's a massive transfer of wealth from the member to one small part of the finance sector. And I just don't think that that's right. So I just felt that if I could bang on about it, other people would get on board. And I know that my fellow colleagues up here share the similar views about it.
You've captured all the press, though.
Well, that was just an accident. But, we've had discussions with them, and I think it's just a matter of, you choose to push a particular issue, and that was the one we chose to push. But I would be surprised if they think very differently about it.
Okay. So in other words, you're making Frontier relevant, by getting out there on the front foot and talking about new ideas. Whereas Graham said before, now that we've introduced chief investment officers and internal investment teams, I think you're alluding, Graham, to the fact that asset consultants are irrelevant now. Isn't that what you said?
I think you misunderstood me, Michael. What I actually said was that asset consultants have never been as relevant as they are today. And the reason for that...
I did misunderstand you.
No, look, I think the nature of investment consulting relationships is changing. And the challenge for all of us up here, and indeed for the challenge for all of you out there, is for us to remain relevant to your organisations and for us to continue to add a lot of value to you. What we found as our clients, as a general rule, have added depth to their investment resources. What we've actually found is that to date it's enabled us to get a lot closer to them, to work much more deeply with them, and from their perspective enabled them to extract substantially more value out of the relationship, because they've now got people who've now got the time, the resources, the capacity to explore areas, to explore ideas and opportunities which would otherwise have been closed to them, and indeed to implement very often in a real-time basis, which is actually what is needed. And so I see this largely as a sort of complementing the current structures rather than... I see the internal teams at our clients really complementing rather than replacing the services that and the advice that we've provided to them. Now, obviously, we do need to specialise. We do need to raise the level of investment competence, the level of investment expertise, and in particular the specialist expertise in our teams. But by and large, we are doing that, and we find that the organisations that we compete with are doing the same.
Thanks, Graham. Ray, I've got a question for you, and I found it interesting. I was talking to Ray yesterday at the exhibition show, and he was saying he was at an asset investment conference recently, and he needed a pen, so he went out to the trade area and he went along to one of the exhibitors who was giving away pens in a very nice case, and they look very flash, and he said, "Oh, could I have one of those?" And the young lady behind the counter said, "No, these are for the important people." So it's very good of Ray to relay that story. Ray, as the person who's probably got the greatest level of experience on the stage, I want to know whether you've done a good job or not. I mean, for all the money you've charged over the years, can you look back with pride and say, yes, I've done a good job? Okay, Ray, good. Thanks, John.
Well, if he doesn't know the answer, let me.
Well, have I done a good job? Have asset consultants done a good job? I could probably very difficult for me to give a frank answer to the first question, have I done a good job? I probably feel reasonable satisfaction. I would probably say, let me just sort of broaden it a little bit and say, probably how high do you set the hurdle? Most asset consultants set the hurdle relatively high, and I would say that most of them would say they feel they probably could have done a better job. So no, they probably haven't done as good a job as they would have liked. Why haven't consultants generally? Probably the constraint is that it has been for a long time a continual process of just sort of basically just trying to get more in terms of fees for asset consulting fees. I think it's been, and I have a bit of a bee in my bonnet about this. I think probably, if I went back to 2000, probably a consultant in that time, an asset consultant was probably paid about, if a consultant was paid the equivalent of $2, then the internal staff working on investments might have been taking $1 out of the budget of the fund. Now that number has moved to probably consultants get double what they did 10 years ago, and the internal staff are probably getting something like about $15. So there's been sort of, to some extent, when we were continually asking for more resource, more fee, we really didn't want more profit. We just basically wanted to have the capability to do, allocate more people and more time to this type of exercise. The things that we've probably done badly across the industry, and I hope I'm not guilty of this myself, is that the quality of advice across the client base has been inconsistent. And I think again it comes back to the fee. If you, for clients who were paid reasonably substantial amounts of money, who paid reasonably substantial amount of money, they got pretty good service and they got the results. Been a number of areas, what we've done in the alternative assets is certainly a lot better than what the master trusts have done, and sort of we've been good, but still really not first rate in terms of the innovation in that area. To some extent, the way we deal and work with managers is not good enough as well. I think our asset allocation advice has fallen down very badly. We should have been, at some stage, we've been sort of, appearing to suggest we do give asset allocation advice, but it's really a very, very passive approach to advice. But I guess at the end of the day, the test is if we look across the performance of superannuation funds relative to, which do have a large asset consultant penetration, and we compare that to master trusts that have a relatively low asset consultant penetration, there is a substantial difference in the performance. And I think part of that credit must go to the work of the asset consultants. I think some of it, of course, it's very hard now to differentiate between the investment staff, asset consultant and the trustees, but collectively, and they do work now as a collective, they have delivered something for some time which is significantly better than what we've probably got in the master trust area. So that's probably a yes.
Okay, so yes, you have done a good job. Have we paid too much for it?
Oh, no. Look at my shirt.
Look at my
Yeah, we've got a
shirt.
picture of it, yeah, we've seen. John, what do you think? I mean, have we paid too much for our asset consultant? I've got to say my hand quivers each time I sign the cheque.
Sorry, I forgot my mic was on.
Fiona, we did script some things, but that wasn't a joke.
I think, well, part of the problem, I think, Michael, is that you are actually signing a cheque, and so our fees are completely visible to you. The vast majority of fees that you and everyone else incurs in this room are not even visible to you. You don't see them because you're not signing a cheque. They're the fees that you're paying to your investment managers, to your brokers, to all the other participants in the food chain. And if you actually look at the investing food chain, if the food chain goes from sort of the floor to here, the fees that you're paying to investment consultants take to about there. And the rest is basically investment management fees and investment brokerage fees. And if you were to then draw the same pyramid in terms of value, I would argue that the pyramid is almost, but maybe not completely, but almost inverted. So your hand should not quiver at all, Mike.
Okay, well, John, I asked you the question.
I would answer it a different way. I actually probably, when investment management choice came in and asset allocation was virtually handed over to the individual, which was a mistake in a sense because we gave a lift up to the self-managed, because the self-managed super, someone in self-managed goes cash or equities, like it's a two-way bet. we put our hands behind our back as asset consultants and investment and trustees and basically said, well, we're going to have the best balance fund, or we're going to have the best here, and we basically tied our hands behind our back and we forced a member into that, and we didn't actually asset allocate for them because we put these bounds and ranges around them because we were told to by the regulator. And so we have actually made ourselves slightly irrelevant. So in my humble opinion, Michael, bring on Jeremy's universal and let's respray the balanced fund and get back to trustees having a real, and asset consultants having a real input into the asset allocation that we actually hand to our members. Could we have actually changed if we'd known about, if we had forethought on the whole GFC, would we actually have been able to implement anything that would have protected our members anyway? I mean, the reality is, because of these bans we had around our balance funds, we killed ourselves. We killed our members even. So, come on, Jeremy. Come back to and do the spray paint job for us.
So what you're saying is don't blame me?
Sorry?
You're saying don't blame me, the consultant?
No, blame me because I think what's happened is that the asset consultant industry, we've spent so much time worrying about being able to pay our staff and running a business that we have not got involved in the public debate with government about how the industry works. We've been so busy competing against each other, worrying about whether we can employ the next person on our staff, that we didn't get involved in the public debate. Really, we left it up to other organisations, and we've copped this. So it's our fault.
Fiona, did we pay too much?
Well, I don't think we do. I mean, we have $100 billion under advice and our revenue is $10 million. So you can do the maths. That's revenue, not profit either, just in case you thought I might be confused. But I think, I think the thing that I always think about is value versus cost. And what worries me a lot is that when we go to tender for some things, one of the first things people talk to us about is the price. And I look and think, if I was choosing someone to work in a specialist role, it's not like going fixing the toilet if it's broken or whatever, this is a specialist role where you're paying for a team of experienced people. It's not clear to me why the first thing I would be arguing about is cost. Then you get, the playing off, well, you might not make the tender because this, that and the other, and you think, oh my God. And in the end it tends to be, some small number of thousands of dollars that's being debated over. And I think that people need to recognise the difference between value and cost. And if you look back at what value you can add across portfolios over time, you tend to find that the price you pay for an asset consultant is easily compensated multiple times by the value that a good firm can add. So I think if people could think more about in a value-added context, and performance fees are one way of testing the boundaries there, then that would seem to me to be positive. But I don't think you could argue that asset consultants are paid too much. In fact, sometimes I have a dream, and my dream is, what if our revenue was double? What would I do? What could I do? What people... No Bahama holidays.
Oh, right.
That's for you in that shirt. That's where that shirt ought to be, mate. In the Bahamas. But sometimes I think even if we had 50% more, what could I do? What people could I put on? What databases, research, all that sort of stuff. And the grand scheme of $100 billion under advice, an extra $5 million is not a lot of money in percentage terms, but it's a big amount of money in dollars terms. So you've got to be respectful of that as well.
Ray, you had something to say, to add?
Oh, no, I was just going to, I was actually just a bit of a side. I thought John had opened it up for the Coombs review of investments. And,
we might be
shelving the Cooper review and having a Coombs review next year.
Yeah. And Michael, just a last point on fees and stuff like that. If we were getting paid so much and everybody, was so wealthy as asset consultants, why have so many asset consulting firms gone broke? Why is it that there's probably half the number of firms that there was 10 years ago? And the reality is it wasn't because they were bad, it was just because everyone was competing on price.
After that, you guys were all getting the tissues out, I think. It sort of Ray, I wanted to ask a question about the global financial crisis. Did you see it coming, and did you tell anyone?
Did we see the global financial crisis? I think no, we didn't see the global financial crisis come in. Anyone who tells me they saw what we will say is a global financial crisis, I find difficulty believing that. We were very wary about valuation in equity markets about 4 or 5 years ago, and we're doing some work. We're doing a lot of work with. A lot of it was driven by the bear himself in Jack Gray, who at that time was CIO at Sun Super. So to some extent we didn't really see it, but we were, we're working. Jack wanted to explore those type of scenarios, and it goes back a little bit towards what John was saying before. Even though we did that, we designed a lot of strategies. Except, interesting thing, there was some peer group, there was some resistance for peer group reasons, for people to be very defensive in the around that time, even though there was that valuation concern. So, we did things like, we favoured strategies like distressed debt. We were reluctant to put any money into private equity buyout funds anymore. Steered way clear of the over-leveraged mega private equity funds. Looked at other strategies. Kept putting, infrastructure was okay. It was valuations. So we did a lot of things. But the big mistake we made, at the end of the day, it was just around the edges. It really didn't make enough difference, and maybe that was something that we didn't do properly, and maybe that was because we were too day-to-day in the way we run the business, and we didn't sit back and, consultants probably should go away and lock themselves away and do very deep research work for a month or something like that, but they don't have that luxury, and that's what Fiona was referring to earlier.
Okay. John, I've heard you talk about good and bad clients. What does a good client look like?
You, Michael.
Oh, yeah. Okay, thanks, John.
Great trustee boards who know what
that's
they
enough,
want.
John. Thanks. Great.
No. To be serious, great trustee boards who actually know what they want. I mean, the best client you can have is someone who has a clear vision about what they want, know their members, know what their members want, and are passionate about that. See, the worst thing, and a bad client couldn't give a stuff about their members.
Would you like to name anyone?
No. Oh. But I'm just saying, the worst ones are the ones that really don't. I mean, this is what worries me about professional trustees. I seriously worry about professional trustees because they don't know their members. They have no clue about the membership of the funds they will be on, and they don't give a stuff as long as you write out a cheque for them, to be quite honest. And we were talking about it, Dean was talking about it yesterday, and talking about governance and all that sort of stuff. If the funds can't govern themselves, what hope is getting somebody in from outside who's an independent going to help someone who can't govern themselves? It'll be farcical. So if you can't govern yourselves, get out of the room. There's lots of mergers.
Thanks, John. Fiona, I wanted to ask, where do you put your own superannuation money, bearing in mind you look after a lot of not-for-profits?
Yep, 2 industry funds, and they're very cheap, so I can afford to pay for 2. And I think a bit of diversification is not a bad thing, but 2 industry funds, my superannuation.
Are you giving both the advice?
They're Frontier clients, 2 of their 2 Frontier clients.
Graham, you must have a split personality. Where do you put yours?
I'm a member of one of these very rare animals at defined benefit, a corporate defined benefit super fund, Michael.
Ooh. You can't wipe the smile off his face, can you? Talk about us and them.
Last year, Michael.
What about you, Ray? Where do you put your money?
A bit like Fiona, 2 superannuation funds, one a client, one not a client, and I've got to be honest, I've said to a few people and somebody over the last year, I've been toying with the idea. I do have a self-managed fund with no assets in, but I'm toying with moving a significant part of the portfolio into the self-managed fund.
Gee, how low have we sunk?
If one to the client one, it'll be the other one.
And finally, John, where have you got your million stashed?
Mine's self-managed, Michael. NAB Superannuation Fund. We happen to be the consultant for them. And as an employee, my money goes there, and it's a very generous scheme because they pay all the admin.
You're part of the bank, John, are you? I forgot about that.
I'm from a bank and I'm here to help you. Yes, I know. Yeah. Thanks. I want to ask each of you a closing question, then I want the lights to come up if we could, because I'd like to get some questions from the audience. But where is the asset consultancy, Graham, starting with you, where is the asset consultancy business going to be in 10 years' time? We've looked back over 20 years. You've talked about the rise of chief investment officers and internal teams, the relevance of asset consultants going forward. We've heard that everybody is finding it very hard to survive on the fees they get at the moment, even though some hands quiver when I sign those $1 million cheques. So could you tell us where you see the industry being in 10 years' time?
Jeez, we're not going to get that.
To a very large extent, I think the answer to that question depends, Michael, on where the super fund industry is in 10 years' time. But I'd like to think and I'd like to hope, and I'm pretty confident that the investment consulting industry will be comprised of those organisations who are the survivors, and the survivors in this industry are those that are going to continue to be relevant to their clients, continue to put their clients first and position themselves and their clients where they're able to consistently deliver a significant and sustainable competitive edge. So larger, deeper relationships, more specialised services, and continuing to add value, substantially more value than the fees that they're receiving.
Fiona, Frontier?
Look, staying relevant, however defined, is obviously critical. And I think if not, and if you're not adding value, then you ought to do something else. And you need to have the guts to say, this isn't working, we need to go and do something else. But at the moment, relevance is probably defined, I think, in more specialisation and access to experienced people. That can change, as Graham says. And I think from an internal team or a trustee perspective, you ought to want to work with great people wherever they are, whether they're in asset consulting firms, fund managers, brokers, wherever. I mean, there are a lot of smart people around. You might employ some of them, but you might also not employ some of them directly. And access to a broad group of smart people thinking about your issues is a pretty good solution to me.
John?
I think we'll be fund managers, Michael, unless the whole structure changes, because if government legislate for large consolidation, then we'll go the way of being fund managers or running consultancies that are, tailored directly to one asset class or something like that, because there just won't be enough money to go around. And I think we could be dinosaurs in 10, 15 years. We might look back and go, gee, they helped us out, through that growth phase, but they're no longer relevant.
Sorry you used the word dinosaur, Ray, but last word to you.
Well, I've probably been around longer, and I must say that I am concerned about, for the industry in general, about where it is at the moment, because there's some signs that we are a specialist consultant, and I'm very happy that we're in that territory and in that space of a market in alternatives, because the issue really is about the internal investment team, and they're becoming, in a way, in some cases, I see them becoming the new gatekeepers in our industry. I heard of an instance recently where someone was complaining to me that before the asset consultant could go into the trustee meeting, they had to give a very clear explanation to the internal team what advice they were going to give and what they were going to say in that meeting. It was suggested they change the advice that they provide. Now, if I was a trustee and having been in the industry as a trustee for 20 years and got used to the old model, I think I would have been pretty happy with the old model, because in those days what they wanted to hear was absolutely what that asset consultant thought, and they wanted to hear that on quite a range of matters. It's always been the case that the asset consultant has to be very proactive with high quality advice, etc., unafraid to deliver that advice to the trustee with a common a common goal of giving the best result for members. So I'm a little bit, we're starting to develop into a world of politics, and the investment staff do have a balance of power now rather than what was previous model. I think it's the industry is under a bit of threat at the moment.
Thank you. A sobering thought. Could I have the house lights up, please, if you wouldn't mind?
Down.
And questions from the audience. I think we do have numbers or something like that. Could somebody wave? Number one over here, if you could announce your name and where you're from.
Hello.
It's working.
Lindsay Oxlade from South Australia, Statewide Super Trust. One of the things I have noticed in the experience of the last 2 years has been that several things in the asset consultants' lexicon, if you like, have fallen down. The models generally have proven to be wrong or not sustainable. And also there's a, if I can use the word, the theory that underpins a lot of advice seems to have been demolished. There's an assumption that things revert to means, and there's an informed investment market out there. So what we will be certainly looking for in the future is an acknowledgement of the changes that have been made and how the investment advisors are changing their view of the world and the advice they're given, because like a lot of funds, we have set up our own investment team, and we encourage our investment advisor to give the full and frank advice, and the investment team sometimes says no. And so we have a debate, which is good. But the real problem we've found is that some of the underpinning theory is, to put it mildly, crap. Where do we go from here?
I hope none of you provided the crap advice.
If I could have first go, Lindsay, I think that's a good point. I mean, John mentioned earlier, I have two things which I think are absolutely critical. The fund has to have a very clear investment strategy plan and stick to that plan. The other thing is that the consultant, in conjunction with the fund, have to develop a well-articulated set of investment beliefs. And this is probably what have those investment beliefs held up well in the last 3 years. I would think in terms of our investment beliefs and the beliefs I do see the other consulting work that gets done in this area, actually we're probably a sort of minor exception. The actual, they have held up. They're thinking about efficient markets, etc., thinking about fees and costs and what you pay and stuff like that. I think it's actually held up fairly well. I don't think there's a glaring, perhaps, I may be wrong, but...
Yeah, look, I think the only comment I would add to Ray's is that I absolutely agree that you can be too theoretical about this. And one of the very big dangers of this industry, and in particular the people who are attracted to the industry and who are trained to come into the industry, is that a lot of this, that to a very large extent, a lot of us are sort of quanti kind of people, and we're looking for the right model or the right answer or the right set of assumptions. And one of the most valuable things we can bring to the process is an acknowledgement that the answers aren't always quantitative, that the models are not always right, and hedging against the likelihood, almost certainty, that your model or that your central view is going to be wrong is essential.
Okay. Number 3, I think, was up the top there.
Barry Watchorn from Care Super. John, you lamented the fact that during a pretty critical stage, the asset consultants had not had the opportunity or had not taken the opportunity to make a contribution to the debate that was going on at the time, and didn't have the voice to express this. If you had, what would you have said?
I think, Barry, I would have said to the regulator, we need to sit down and educate you and talk to you about that you need to give us much broader and wider ranges and powers, and be not so restrictive to stop us actually crafting this. I think a lot of the regulators, they do come from academia or come from a sort of quanty, nerdy type background, and they haven't actually worked in the industry to know that there aren't absolutes. There is no absolute in this. I mean, at the end of the day, it's about a judgment call. It's all about weighing up. There's a great... David Paradise said something to me one day, and it's resonated with me forever. There's sizing of risk, and it's absolutely true. Every investment has a risk, but you have to size it properly. Some people haven't learned how to size it properly. The academics can look at a whole lot of modelling and stuff like that, and they will tell you to do something, but it's not practically right. And you'll put too much risk on the table and you'll make a mistake. And I think that's what I'd go. That's, if I had my time again, I think, you know.
Thanks, John. One question over here, number one, up the top there. Thank you.
Greg Nolan from Care Super. A question to you, John, and that is a shocking shirt, by the way. And I hope you're not going to wear it tonight. If you are, come back to my room, I'll give you another one. The question I've got is about conflict of interest within the asset consultants. It just seems to me that some asset consultants do make it difficult for themselves by going into funds management, and John, you alluded to that before. And I think that is of concern to some trustees. Have you got any comment on that strategy of some of the asset consultants?
Oh, look, we're one who did it. So I can talk from a big experience. We went for a asset consulting job in 1993, I think it was. And the winner of the bid process did it for a third what we would do it. So John Nolan, myself and Ian Rhoda sat around and said, holy moly, we'll go broke. We can't make money at those fees. So we set up Warrakirri, what is now Warrakirri Asset Management, because the only way that we could make money was to get into funds management. We didn't have the beauty of having backers, you know, funds backing us, no offence, Fee, but we didn't actually, like, we were running a business, and this is what I was saying before. We were running a business. We had to look after our business interests, and so we went into funds management. Did we want to go there? Did we understand the conflicts? Bloody oath. Did we want to go there? No. But we had to go there because we had to go there to survive. Otherwise, we would have been the next Jarks Martin or something like that, you know. Goodbye.
Thank you, John. I think we'll call questions to a close there. And I think you'd all agree with me today that we've had 4 very honest and open consultants who have really sort of given us their straightforward views. So to Graham, to Fiona, John and Ray, would you please put your hands together and thank them?